Yo, yo. Well, what's good, everyone? Happy Saturday. It's your boy Chuck here, Chuck Broomberg. And today, yeah, we're going to dive in a little deep here, like real deep. Because basically, the market just put up its longest winning streak since 2009 through, I don't know, but it's like 12 straight days of gains on the Nasdaq, and everybody's celebrating, right? Everybody's talking about AI, semis, tech, Fed pivot. I mean, that's the surface, right? At least, you know. But underneath that surface, there's a web, right, of macro risks that most retail investors are not watching, and every single one is connected to the other. So today, we're going to talk about the Bank of Japan and why the yen might be the most dangerous thing in the global markets right now. We're going to break down the yield curve, both the 10-year minus 2-year and the 10-year minus 3-month spread, and what they're actually telling us about potential recession or stagflation. We're going to talk about the US debt versus our GDP because those numbers are genuinely fucking alarming. And we're going to break down the Iran conflict and how it ties into all of this. You dig? By the end of this video, you're going to understand how all of these things work and how they're connected because they do. Every single one of them. Every fucking one. And when you see the full picture, the 12-day Nasdaq winning streak looks a lot more fragile than the headlines suggest. Let's get into it. All right, so let's talk about this Nasdaq streak, right? So let's start with what you already know, because context does matter, right? On March 30th, the Nasdaq bottomed at about 20,794, right? Which also was about for QQQ. For those who follow the QQQ, which is the Nasdaq ETF, exchange traded fund. If you don't know what that means, bottomed out around 555.60 cents. Okay, on March 30th, just to give you context. Now, that was the war discount, right? You dig? Full Iran uh, conflict premium baked in, okay? Oil above $100 a barrel. Strait of Hormuz blockaded. Geopolitical uncertainty fucking everywhere. April 1st, ceasefire talks. Start with Pakistan mediating, relief rally kicks off, shit like that, right? But here's the thing. Relief rallies fade in 3 to 5 days. This one ran 12 consecutive sessions straight. You dig? Nasdaq closed at 24,102, a new all-time high. That would put the QQQ, I think, closing at 648.85. It did hit 650 on the dot. Funny. Friday session, yesterday's session, the 17th of April. But that being said, anyways, yeah, that's the longest winning streak since 2009. Nearly 14% off the lows in less than 2 weeks. Now, the market's pricing a best case scenario here, right? Ceasefire holds. Iran deal gets done. Oil drops. Fed stays patient. AI capex translates into fucking revenue, not bullshit. No recession. That's a lot of things going right simultaneously. You dig? And the concentration underneath, it's so thin. Semiconductors and mega cap tech, or whatever, are doing all the heavy lifting here. SOX, the semiconductor ETF, is up 23.5% in April alone. Energy lagging. Financials flat as a rock. Advancing stocks outpacing declining, but just barely when you look at the breadth indicators carefully. The McCollin oscillator screaming overbought, above plus 80. That historically precedes a reversal within 1 to 3 weeks, okay? You dig? Do you understand what I'm saying? Bullish percent index now, it's above 85%. That's distribution territory. Put to call ratios compressed. Nobody's fucking hedging. So we've got a historical rare streak, concentrated momentum, fucking weak breath, and extreme sentiment. Now let's zoom out and look at what actually drives the global liquidity pool that keeps this thing afloat. Now I know a lot of y'all have heard me harp on the Bank of Japan and all that shit plenty of times, and the Japanese yen carry trade and all this stuff, right? But I'm gonna get a little nitty gritty with it, okay? Because it is like the real fucking wild card here. So this is where it gets real. Most Americans don't think about Japan when they look at their stock portfolio, right? Big mistake, in my opinion. The Bank of Japan might be the single most important institution in global markets right now, and most people have no idea why. Some of you in the Bag Brigade, obviously, who pay attention do. But here's the setup, okay? So for 25 years, 25 years, Japan kept interest rates at effectively zero, sometimes even fucking negative. While the US, Europe, and the rest of the world had rates above 1, 2, 3, even 5%, Japan is basically giving away free money. So what did institutional investors, hedge funds, and especially private equity firms do? They borrowed yen at almost zero cost, converted it to United States dollar or other currencies, and deployed it into higher yielding assets like, US treasuries, US stocks, leveraged buyout, global real estate, fucking crypto, Bitcoin, right? You borrowed at 0%, invested it at 5% or more, and pocketed the spread. You dig? Not that complicated. That is the yen carry trade. And it's estimated at anywhere from $1 to $4 trillion in total exposure globally. Let that sink in for a minute, people. Now here's the critical part, right? The Bank of Japan has been raising rates, okay? In December 2025, they hiked to 0.75%, the highest Japanese policy rate since 1995. That was 31 years ago. And the governor has signaled further hikes are possible this year, 2026. That changes everything. Why? Because carry trades don't fear today's rate. They fear tomorrow's fucking path. When you borrowed yen at 0% and deployed it into the Nasdaq ETF expecting 12% returns, the math worked beautifully. Like I've said, it's the sickest hustle I've ever fucking seen on this planet, or in my life, right? But when you get at 0.75%, the spread, that shrinks at 1.25% or 1.5%, which is where some projections have the Bank of Japan going by the end of this year. That spread starts disappearing, and when the spread disappears, people fucking unwind that trade. Here's what the unwind looks like in practice. Investors sell their US assets, stocks, treasuries, ETFs, fucking commercial real estate, whatever, if they can. Then they buy back yen to repay the loans. That strengthens the yen. That weakens the dollar. US assets drop. It's forced liquidation, driven not by company fundamentals, not by earnings, but by a currency math problem in fucking Tokyo. We already saw this movie in August of 2024. I'm sure some of y'all remember that. I don't know, but I know the Bag Brigade people do. At least they were there at that point. The Bank of Japan hiked just literally 15 basis points, barely a quarter point, and within 48 hours, the Nasdaq dropped 13%. Bitcoin crashed from 64,000 to 49,000, and the VIX spiked above 65. The most violent single-day market moves in years, all triggered by Tokyo. Now the yen is hovering right around that, 160 per dollar. That's the USD JPY. That's a critical level. That is that critical level that I have been talking about for a long time. The yen has depreciated 54% since 2021. Every time USD JPY approaches that 160 level, it gets attention from Japanese authorities who have historically inverted verbally or directly to support the yen. More importantly, at 160, the carry trade is still very much alive, which is part of why risk assets have been rallying, right? But here's the risk. If the Bank of Japan hikes again at their June 2026 meeting or signals a more aggressive tightening path, USD JPY could go from 160 to 140 fucking fast. That move alone would trigger a massive carry trade unwind like you've never seen before. And here's the private equity angle that almost nobody is talking about. Private equity firms have been borrowing in at cheap rates to fund leverage buyouts globally. Carlyle just raised 2.8 billion for Japan buyouts. KKR, Blackstone, all the big names have been using yen-funded leverage to juice returns. See, these deals are denominated in foreign currencies but funded by the yen. When the yen rises, those deals get way more expensive to service. It squeezes return multiples, right? It creates pressure to exit positions, meaning more assets hitting the market. So connect the dots. Bank of Japan hikes, the yen strengthens, carry trade unwinds, leverage risk assets sell off, private equity deals get squeezed, equities drop, volatility spikes. See, that's the chain reaction. It can happen fucking fast, and that's what August 2024 showed us. See, right now, the Bank of Japan signaled they probably won't hike at their April 28th meeting, partially because the Iran situation adds uncertainty to Japan's inflation picture, but the data points to future hikes by mid-2026. Okay? Japan's 10-year JGB yield is above 2% for the first time since 1999, baby. Wages are growing. Inflation, it's sticky. The Bank of Japan neutral rate is probably somewhere between 1.5 and 2%. We're at 0.75%. That's a lot of hikes still potentially coming. You better watch that 160 level on USD JPY, I'm telling you. If we break above 162, intervention risk rises and the Bank of Japan gets way more fucking hawkish. If we break below 155, the carry trade unwind accelerates. Either extreme is a volatility event for the United States market. Period. You dig? Okay, now let me talk about something that most YouTube financial guru channels or whatever avoid because it sounds fucking boring. The yield curve, right? But I promise you, this might be, I don't know, one of the most important charts you're not looking at. See, here's the basics. The yield curve plots interest rates on US Treasury bonds across different maturity dates, right? Normally, longer term bonds pay higher yields than shorter ones. That's normal. That's healthy. Short term rates reflect what the Fed controls, right? Long term rates reflect what the market thinks about growth and inflation. When the curve inverts, when short term rates are higher than long term rates, that's a signal. The bond market is saying, hey, we expect growth to slow and rates to come down eventually. We don't believe the short term environment is sustainable. Every single recession since 1950 has been preceded by a yield curve inversion. Every single fucking one, okay? We just ended the longest yield curve inversion in US history, okay? It started in late 2022 and lasted 27 months. Now, here's what most people get wrong: an uninversion is not an all clear signal, not by any means whatsoever. Historically, the recession doesn't even happen during the inversion, it happens after. When the curve begins to normalize, that's when the recession typically arrives. Average lead time, I don't know, 6, 12 months after the inversion. Right now, the 10-year minus 2-year spread is approximately about plus 51 basis points. It's something like that. That means long-term rates are finally above short-term again. The curve has steepened. But here's the critical detail: it steepened because long-term rates rose, not because short-term rates fell. The 10-year yield hit 4.3%, 4.39% in mid-April of this year, basically just recently. That's called a bear steepener. And a bear steepener is way more dangerous than an inversion. It means the bond market is pricing in structural inflation and excessive debt issuance, not growth. Okay? You dig? Now look at the 10-year minus 3-month spread. This one actually, what the New York Fed uses to calculate recession probabilities. Right now, they've got the probability of recession in November of 2026 at approximately about 25%. That's not nothing. That's not screaming crash either, though, right? But 1 in 4 odds of recession in 12 months while the stock market is hitting all time highs. That is definitely a mismatch you need to account for, you dig? Here's the bottom line on yield curves. The curve is telling you that the bond market is worried about long-term sustainability, not just short-term rates. When you combine a bear steepener, a 27-month inversion that just ended, a 25% recession probability from the New York Fed, a 10-year yield above 4.3%, that's a lot of warning signals stacking right the fuck up on top of each other. The stock market is ignoring every single one of them because sentiment is so hot. But the bond market, well, it doesn't lie forever. I've always said, watch the bonds. What are the bonds doing? They're kind of like the market snitch. Remember, equities lie last. You dig? Now, this section is the section that people don't want to hear, but it's arguably the most important one, okay? Talking about the US GDP versus our debt. Right now, as of Q4 2025, US federal debt as a percent of GDP is 122.6%. That's not 100%. That's not 110%. It's 122%. Our national debt, over 39 trillion with a T, is bigger than our entire annual economic output. The last time we were anywhere near these levels, can you guess? World War II. And we were mobilizing the entire industrial economy to fight a global war at that point. The CBO, the Congressional Budget Office, projects federal budget deficit for fiscal year 2026 at 1.9 trillion. That's the gap between what we spend and what we collect in taxes. So they say. In excuse me, in just 1 year, right? And they project debt rising to 120% of GDP by 2036. That's 10 years from now, under current law. Some projections, if current spending trends continue, put debt to GDP at 175% by 2056. It's fucking crazy. Now, here's why this matters for markets, right? When debt, right, is this high relative to GDP, there are basically two ways to manage it, right? Grow your way out or inflate your way out, right? Growing your way out means strong real GDP growth. I'm talking 2.5%, 3%, 4% annually, okay? The CBO projects real GDP growth of about 1.8 to 2.2% over the next several years. That's not enough to outrun this debt accumulation that we've got going on. Inflating your way out means letting inflation run above target, effectively eroding the real value of the debt over time. But inflation above 2% means the Fed can't cut rates aggressively. And higher rates mean higher interest costs on that 39 trillion pile of debt. In fiscal year 2026, interest payments on the national debt are already larger than the entire U.S. defense budget, people. You dig? We're spending more on interest than on our fucking military. That is not a sustainable equation. The 10-year yield sitting above 4.3 is directly connected to this. Bond investors are demanding higher rates to compensate for the risk of lending to a government running a 1.9 trillion annual deficit, right? As the supply of treasuries goes up because we keep issuing them to fund deficits, prices fall, yields rise. Bond price down, bond yield up, okay? Rising yields become a headwind for equities because they raise the discount rate on future fucking earnings. And they make that yen carry trade unwind even more complicated because Japanese investors, the largest foreign holders of US treasuries, have to decide whether to keep holding US debt or, basically bring that money back home to Japan, where domestically their yields are finally rising. Think about the chain, right? Japan raises rates, the yen carry trade unwinds, Japanese investors sell US treasuries, treasury prices fall, the US 10-year yield spikes, equity multiples compress, and the market starts to correct itself. That is a genuine systemic risk scenario, my friends. It's not guaranteed. It's not imminent, but it's fucking real. And here's the honest assessment. The US has a debt problem that cannot be solved by the Fed alone. It requires either fiscal restraint, which neither party has shown appetite for, or a combination of growth and managed inflation. The good news is AI-driven productivity could genuinely boost GDP growth. The bad news is that's a 5 to 10 to maybe even a 20-year story, not a 2026 story. And we're running $1.9 trillion deficits today. Mic drop, you dig? Hope you got something from that one. Here's what I know. The market right now is pricing perfection. 12 consecutive up days, new all-time highs, breadth indicators screaming, overbought, overbought. Nobody hedged. Maximum bullish sentiment. And underneath it all, well, you got a fragile ceasefire that could collapse, a Japanese central bank telegraphing rate hikes, a yield curve that just ended the longest inversion in history, which is when recessions historically arrive, and a debt to GDP ratio at about 122% with a $1.9 trillion annual deficit. You don't have to predict which domino falls first. You just have to understand that the dominoes actually exist and manage your risk accordingly. That's what we do at the Brigade. We don't let narratives override data. At least I don't. We follow the signals, respect the risk, and position to survive any scenario. Because the traders who survive the corrections are the ones who add back at the bottom. And you can only add at the bottom if you managed your risk at the top. You dig? If you want live analysis of all this as it develops in real time, the Iran news, the Bank of Japan, um, whatever, in the yield curve updates, earning breakdown, why don't you come join us over at the Brigade Discord community? Link will be in the description. Okay? Now, it's free. We don't charge. We're also not a signal. We don't provide signals. Okay? It's for education. We want, yeah. But anyways, you have to fill out an application, and either myself or one of the mods will review the application, and well, you either get approved or you don't, and that's basically just the way it goes. Okay? I don't know what to tell you. And if you got anything from this video, why don't you do them YouTube things? Hit that like button, subscribe, drop a comment, tell your friends, yada yada, do it all. Because I'd love to answer any questions that anybody has, especially YouTube. Anyone who's just finding this. See, at the Bag Brigade, we're on top of every single one of these catalysts as they hit. This is exactly the kind of macro framework we use to make better decisions, not more reactive ones. So again, drop a like if this connected the dots for you. Subscribe if you're not already. Start rolling with us, I guess. And again, comment. I'd love to know what everybody's saying. What do you think is the biggest risk right now? Is it Iran? Is it the Bank of Japan? Is it the yield curve? Is it the GDP to debt ratio? Let me know. Stay sharp out there, everyone. It's your boy Boomberg over here. I don't ask why. I ask why not. And I no longer accept the things that I cannot change. See, these days, I change the things that I am no longer willing to accept. You dig? And any of these haters out there, or whatever they want to say, especially all the fake Chucks out there on Discord trying to pretend to be me. Well, there's only one Chuck, okay? So, before they cross me, they're going to have to nail me to it, boy. That's all I got. See you on the next one. Mic drop. Boomberg. Out.